Okay, so welcome back to our series as we started solving the financial accounting past question 2000. That's what we started with, okay? And we are dealing with the section A, which is the theory aspect of paper 2. Okay, so financial accounting WASSCE 2000. And we are dealing with the paper 2. The section A aspect of it, and we started with question 1, and now we are on the B aspect of the question 1 because we are done with the A aspect of it. Okay, and the B says we should explain how the item that is listed in A above may cause a difference between the cash book and the bank statement balance. Okay, and we've already listed those items in part A. Okay, so if you have missed that series, can you go back to the channel and then you will find the presentation on that. Okay, so let's start with the first item, the explanation that we can give as to how it affects or it brings about differences between the two balances. Okay, and before you can do that, there are certain things that I want you to bear in mind. Don't forget that each point goes for 2 marks, okay? So you have to explain it, then you show how it brings about differences, okay? So you have to first give explanation to the terminology or the keyword, which is the first one has to do with unpresented check. Okay, so let's see how you can give explanation to that. When we see unpresented check, it's a check that the business have issued out from their business to either a customer or employee for withdrawal, but the person has not presented it to the bank for withdrawal. Okay, so that is the explanation for unpresented check. So how can unpresented check brings about the difference between the bank statement and that of the cash book balances? You know, whenever the business issue a check, the first thing that it will do is to credit their cash book account, so that when the person presents it to the to present it to the bank too will also debit the bank account of the business. But because the person has not presented the check, the bank is yet to debit the bank account of the business. So hence, the balance that is being shown on the bank statement is going to be higher than that of the balance that will be shown in the cash book of the business, because the business has already issued the check and they've credited their cash book account or their cash book. But because the person is here to present it to the bank for withdrawal, the bank has not received the check and they've not made any debit entry in the bank account of the business. So hence, the two balances are never going to be the same. Okay, so you give the explanation like what I've given it to you, then you show how it will bring about differences so that you can get the maximum score. Okay, don't forget to do that. If you don't understand anything, just leave a comment at the comment section and I will be happy to attend to them. Okay, and if you have not subscribed to the channel, can you do that for me? Okay, so let's move on to the second aspect of the suggested answer, and it has to do with uncredited check. So what is uncredited check? Uncredited check is a check that a business has received either from a customer or any other related party, and they've debited their bank account in their cash book, but the business is yet, or the bank is yet to credit it in the business bank account. Okay, so uncredited check is a check that the business has received either from a customer or any other related party, and but the bank is yet to credit the bank account of the business. Okay, so the business has received a check from either a customer or any related party, but they've sent it to the bank for the bank to credit their bank account, but the bank is yet to credit the bank account of the business due to one or two reasons. Okay, so when you say uncredited check, it's a check that a business has received from a customer or any other related party, and they've presented it or they've sent it to the bank for credit entry, but the bank is yet to credit the bank account of the business due to one or two reasons. Okay, so this is the explanation that you can give. So let's see how an uncredited check can bring about the differences between the cash book balance and that of the bank statement balance. Okay, the moment the business receive a check from any of these people, the first thing that they will do, they will debit their bank account, because the money in the bank account is going up, and the debit entry or the double entry principle for asset, which is bank, when it is increasing, you have to debit the account. Okay, so here, whenever a business receives a check from any party or from any person, the first thing that they will do is to debit their cash book. Then the bank is supposed to do a credit entry in the bank account of the business, but because the bank is yet to do the credit entry in the bank account of the business, or they've not made the credit entry in the bank account of the business, the balance between the two is not going to be the same. Okay, because the one being shown in the cash book is going to be higher than the one on the bank statement. Okay, because the bank has not added the check that they've received from the business to their money, or in the money in the bank account. Okay, so the balance on the bank statement is going to be lesser than the amount or the balance shown in the cash book. Okay, so this is how uncredited check brings about differences between the cash book balance and a bank statement balance. Okay, so as I said, uncredited check is a check received from a related party or a customer, and the business has presented it or sent it to the bank for credit entry, but the bank is yet to make such an entry in the books of the business. Okay, I hope you are good on that. Then let's move on to the third aspect of the answer, or the suggested answer, which has to do with bank charges. What is bank charges? You know, business, whenever they open bank accounts with any bank, the bank does so many transactions on their behalf, and as a result of that, the bank normally charges some fee for providing services to the business. Okay, to the business. So when you say bank charges, it's a fee that the bank charges the business for providing services to the business. Okay, so this is the explanation that you can give. So it's a fee that the bank charges the business for providing services to the business. Okay, so let's see how bank charges can bring about, or before that, you can example that you can think of, like giving the business a checkbook. Okay, a checkbook, some of the banks is not for free. Whenever they give a checkbook, at least they will take some amount of money from you. So these are some of the examples that you can talk of Okay, so bank charges has to do with the fee that the bank charge against the business for providing services to the business. So let's see how bank charges brings about differences between the two balances. You see, whenever the bank charges such a fee, it debits the bank account of the business. But most of the times, the business are not aware of such charges. Okay, the businesses are not aware of such charges. So because of that, they are not able to credit their cash book. Okay, because they are not aware of the charges that the business or the bank has made in their bank account, they are not able to also make a credit entry in the cash book, and for that matter, the balance that will be shown on the bank statement is going to be lesser than the balance that will be shown in the cash book of the business. Okay, so this is how bank charges brings about differences. Okay, so I hope you are good on the explanation, and then you're also good on the how bank charges brings about differences between the two balances. Okay, so as I said, if you don't understand anything concerning what I've said, you can let me know and I'll give more explanation on that. So let's move on to the fourth aspect of the suggested answer, which has to do with standing orders. Okay, so what is standing orders? I'm sure you know what is meant by standing orders. Okay, so at times, because the business engage itself in so many transactions, it becomes difficult for them to also at times undertake all the activities, because some of the business, they are into so many activities, and to make things easier for them, they try to communicate with their banks to undertake some transaction on their behalf. Okay, so when you say a standing order, it's an instruction that the business gives to the bank to undertake a particular transaction on their behalf. For example, you can talk of maybe they can give an instruction to the bank that at the end of every month, pay this amount of money to the electricity company. Okay, so to pay their electricity bill or to pay their light bill. So these are some of the things that the business, so you can, the example that you can think of is maybe electricity bill. Okay, so some of the examples that you can think of, they can give instruction to the bank to maybe pay their utility bills, or maybe pay scholarship that they are giving to some of their employees or any other person. So it's an instruction that they give it to their bank to undertake a transaction on their behalf. So standing order is an instruction from the business to the bank for the latter to undertake a transaction on behalf of the former. Okay, so here the business gives an instruction to the bank to undertake certain transaction on their behalf. And the example that you can talk of or think of here is to maybe pay electricity bill, or to pay scholarship fee, or any other example that you can think of. Okay, they can even instruct them to pay some amount of money to their creditors. Okay, so these are some of the things that you can see or you can get under this point. Okay, so don't forget to give example too, because if you give example, you're going to get all the maximum score. Okay, so these are some of the examples that you can think of. So let's see how bank standing orders brings about differences between the two balances. Okay, whenever it's like it's similar to that of the bank charges. Okay, it's the same, like the treatment is the same like the bank charges, but the explanation is different. So let's see how it affects. Whenever they undertake said transaction, they have to debit the bank account of the business. And at the normal circumstances, the business is also supposed to credit their cash book with the same amount. But because at times they might forget, okay, it will escape them that they've given such instruction to the bank to undertake some transaction on their behalf, they might forget to also make the credit entry in their books. And for that matter, the balance for these two statements are never going to be the same. So the balance shown on the bank statement is going to be lesser than the one being shown in the cash book. Okay. On the other hand, the cash book balance is going to be higher than that of the bank statement balance, because whenever the standing order is being carried out, the bank debits the bank account of the business, and because the business is not aware of such debit entry regarding to the standing order, they are not also able to make a credit entry in their books. Hence, the two accounts or the two balances are not going to be the same. Okay, I hope you are good on this. Let's move on to the fifth aspect of it. Okay, I'll do the first one, which is the wrong debit by the bank, and the understanding that you get from there, I'm sure you'll be able to do the last one, which is the wrong debit. So when you say wrong debit, maybe the business, due to the nature of the transaction that the bank has received from the business, they unintentionally commit a mistake in recording the transaction in the books of the business or in the account of the business. Okay, so it's a mistake that the bank unintentionally commits as a result of making an entry in the bank account of the business due to the nature of the transaction or any other factors. Okay, due to the nature of the transaction or any other factors that you can think of. Maybe the cashier, instead of debiting the bank account of the business, he did the credit entry. Okay, so these are some of the common mistakes that at times the banks also make, and it's making a mistake is just something common amongst people. Okay, at times unintentionally they commit due to one or two reasons. Okay, so wrong debit is a situation whereby the bank unintentionally make a debit entry in the books of the business instead of a credit entry. Okay, so assuming the business has presented a check for deposit, and instead of the cashier crediting the bank account of the business, they rather made a debit entry in the books of the business. So let's see how it can bring about differences. Instead of, because the entry was a debit, the money in the bank account of the business is going to be reduced as compared to the one in the cash book of the business. Okay, so the thing is supposed to be a credit entry, but the cashier or any other person unintentionally made a debit entry, and the debit entry in the bank account of the business reduces the amount in the bank account, and because of that, the balance shown on the bank statement is going to be lesser than the balance shown in the cash book of the business. Okay, so this is how the wrong debit brings about the differences between the two accounts. Okay, so we said the first thing you have to do is to give explanation to the point, the keyword that you see over there. When you are done, then you show how it brings about differences, and in explanation you have to try your best to give examples. Okay, if it is possible for you to give example, try your best to do that. Okay, so this is where I will end the series. If you have any questions, kindly leave them in the comment section, and I will be excited to attend to them. Okay, thank you very much for watching. See you soon in the subsequent series.